Coming up on Market to Market. Rural America leaders lobby the White House over renewable fuel levels. And 5 former secretaries of agriculture argue changes in food assistance. Those stories and market analysis with Darin Newsom. Next.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, October 20 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. As fall colors change, the fundamental issue in the housing market remains the same: a shortage of available homes for would-be buyers. The National Association of Realtors says existing home sales increased 0.7% in September, the first gain in 3 months. The Dow Jones played a similar tune, heading higher, crossing the 23,000-point barrier. Never before has trading opened above that threshold. However, on the town square, bankers are starting to get nervous. The Rural Main Street Index reveals another month below growth neutral. The Creighton survey also found 1 in 10 bankers expect farm foreclosures to be the biggest challenge in the next half-decade. Livestock producers lost some recourse this week as the Trump administration killed the Farmer Fair Practice rule that would have made it easier for farmers to sue companies over unfair practices. The White House and the Environmental Protection Agency were at the center of another rural American sector, biofuels, as 4 governors and 38 senators sounded the alarm on rumors the EPA would cut the biofuel mandate. But at week's end, Administrator Scott Pruitt responded with a vow to support the spirit and letter of the law. Josh Bittner reports.
This week, a report surfaced that President Trump directed the Environmental Protection Agency to stand down on a proposed rollback of renewable fuel standard targets for 2017 and 2018. The move came as several Midwest politicians, led by Iowa's state and federal leaders, pushed back at the prospect of weakening the federal program, which mandates a percentage of renewable fuels be blended into the nation's fuel supply.
Our farmers over and over have demonstrated that you can, in fact, feed and fuel the world.
At over 4 billion gallons per year, the Hawkeye state accounts for nearly 30% of all domestic corn-based ethanol.
The renewable fuel standard plays a major role in sustaining our ability to continue as an agricultural leader by giving farmers another market for their commodities.
Iowa Governor Kim Reynolds and industry advocates claimed the RFS was in a precarious position under EPA Administrator Scott Pruitt, who's been tied to fossil fuel interests. Reynolds spoke with both Pruitt and the president by phone midweek to reaffirm Trump's campaign commitment to stick by the thousands of jobs in rural America which rely on biofuel production.
The RFS, which is Renewable Fuel Standard, is an important tool in the mission to achieve energy independence for the United States. I will do all that is in my power as president to achieve that goal.
The administrator has told us in private he needed a little motivation, let's put it like that. So we feel good about where we are. However, I have reminded people we always need to be vigilant. It doesn't matter what administration or where we're at. There's always going to be naysayers when it comes to the renewable fuel standard out there.
While commending Iowa senators for standing up for the RFS,
governors are pretty busy people.
Iowa Renewable Fuels Association head Monty Shaw remained skeptical of EPA, citing RFS opponents' claims that the cost of compliance has driven up prices at the pump. 2 EPA proposals would have both cut requirements for biodiesel and ancillary market for soybeans, and also would have allowed biofuel exports to count toward blend levels in the domestic program.
I hope we're successful in the end of turning this very detrimental actions on the part of EPA, both from the standpoint of agriculture, the environment, and good paying jobs in rural America, but also a departure from the president keeping his campaign promise, which I know the president wants to keep.
To protect jobs in his home state, Iowa Senator Charles Grassley reportedly considered enlisting other lawmakers to help block Trump's nominees to key posts at EPA. Democrats oppose any presidential nomination to the agency, leaving a razor-thin path to approval with the current GOP majority. For Market to Market, I'm Josh Bittner.
The World Food Prize was awarded this week to Africa's version of Norman Borlaug. Dr. Akinwumi Adesina is the president of the African Development Bank. His resume includes transforming Nigerian agriculture through expanded production, reducing corruption, and increasing credit options for farmers across the continent. The annual event honors those helping to feed the world. Domestically, millions of Americans receive assistance to put food on the table. How much and what kind was part of a discussion in an Iowa gathering of the 5 most recent secretaries of agriculture. John Torpy shows us the differing views still surrounding aid.
So I now want to invite to come to the stage Secretary Tom Vilsack, Secretary Mike Johans, Secretary Ann Veneman, Secretary Ed Schaefer, and Secretary Dan Glickman. Join me in welcoming them.
With experience spanning 3 administrations and 3 decades, 5 former U.S. Secretaries of Agriculture gathered in Des Moines, Iowa this week to discuss solutions for food insecurity at the World Food Prize-sponsored Iowa Hunger Summit.
Because I still contend most people don't want to be on these programs. Most people want to get off of them as fast as they can.
The biggest talking points surrounded the program with the biggest budget in the USDA, the Supplemental Nutrition Assistance Program, or SNAP. Starting as food stamps when Henry Wallace was Agriculture Secretary, the program has evolved into a system helping those with food insecurities, providing job training, and to assist people gain self-sufficiency. In 2016, the USDA Food and Nutrition Service notes SNAP served 44.2 million people per month at an annual price tag of almost $67 billion. Critics of the program say the unlimited food choices in SNAP have led to a system of dependency on the federal government. The ability for participants to purchase almost whatever food they want made SNAP a public enemy when it comes to the problem of obesity in the country. According to the Center for Disease Control, more than 1/3 of adults have obesity. Ann Veneman, who was President George W. Bush's first Ag Secretary, called for restricting food choices in SNAP to focus on healthier selections. These actions could help curb government spending on healthcare-related issues in the future.
We're paying for this as taxpayers in Medicaid, in Medicare, for if people aren't putting the right food in their bodies, we're paying it in diseases such as heart disease, diabetes. All of the non-communicable diseases are much more prevalent where we have greater obesity. The SNAP program, we've changed it to the Supplemental _Nutrition Assistance Program. We should be talking much more about nutrition and not just hunger, because nutrition is really the key word.
Secretary Mike Johans, who also served under President George W. Bush, warned restrictions and SNAP benefits aren't going to fix the problem completely.
I tend to be of the school that says, look, a certain amount of restriction, yeah, it's appropriate, but if you think you're going to solve this problem with a total restriction approach, you're not. You have to build in an educational approach that has a broader base to it than what we're doing today, and actually give people good information on how to make good decisions about family diet. But here's the problem. You have people who are able-bodied, and can they make it all work on minimum wage? And the answer to that is probably not.
Individuals receiving SNAP ballooned 42% in President Obama's first 4 years in office before shrinking 7% in his last 4. Tom Vilsack was secretary during that entire time and adds an update is in order.
It also presupposes that people who are receiving SNAP consume around 20 pounds of beans a week. No one consumes 20 pounds of beans a week. So it begs to be reviewed, and I think if it were to be reviewed and aligned with food prices as they are today, you would probably see the need for not fewer dollars, but more dollars in the program.
President George W. Bush's third Ag Secretary and former North Dakota Governor Ed Schaefer praised efforts at the local level, such as food pantries and farmers markets, for food education, and that ongoing research can be a crucial tool.
I mean, there's a lot of research going on that we need to fund and continue to support in changing the Americans' diet.
Despite the differences in how federal assistance programs should work, one point the 5 secretaries agreed on is if the Farm Bill and the SNAP program were pulled into 2 separate bills, neither would pass on Capitol Hill.
Do you think it's a good idea to divide and separate the nutrition programs from the farm support programs? Yes or no on a farm bill, future farm bill?
No.
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 Okay, that's unanimous.
For Market to Market, I'm John Torpy.
Next, the Market to Market report.
A higher than expected harvest coupled with limited export demand weighed down nearly every commodity. For the week, December wheat lost 14 cents, while the nearby corn contract shed 8 cents. Optimal harvest weather and large supplies held the November soybean contract back 22 cents. December meal declined $11.50 per ton. December cotton fell $1.74 per hundredweight. It was another rough week in the dairy parlor as November Class 3 milk futures soured 46 cents. The livestock complex was mixed as the December cattle contract dropped 53 cents and nearby feeders weakened $1.92. The December lean hog contract was a winner with a gain of $2.65. In the currency markets, the greenback was the rare green spot on the board as the U.S. dollar improved 64 basis points. Crude oil increased 11 cents per barrel. COMEX gold melted $24.10 per ounce, and the Goldman Sachs Commodity Index decreased less than a point to finish the week at 402.35. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Good to be back, Mike.
We're glad to have you. And in case you want to go over things again, you can download or listen to our Market Analysis and Market Plus podcasts anytime online at iptv.org/MTOM. Darin, this wheat market continues to grind lower. Looking at your charts from a long-term perspective, is this next point that we're aiming at, is that last year's low, that 398, whatever it was?
You know, the last couple of times I've been on, I've received some correspondence saying I need to be more positive about the wheat market.
Okay.
And if there was ever a chance to, you know, as far as I'm concerned, to be technically a little bit more bullish the wheat, you know, you got to kind of throw out this week. It was just, you know, bad week all the way around in the grain and oilseed complex. But if I look at the weekly chart, monthly chart, it still looks like wheat may be trying to put in a low in here. I don't think we're going to go through recent lows if we look at the December contracts. I think next year's July contracts have a chance to rally as well, the new crop July winter wheat contracts. And on the monthly charts, you know, they're actually holding better together. They're together better than, say, corn and even some of the other well-known markets. So, you know, I think there's, I'm not going to say wheat's just going to turn around and skyrocket in here. They did that little number in June and July off of by following spring wheat. But I think winter wheat's got a chance to hold together as the crop gets planted, goes into dormancy. I think it can hold together, maybe start to rally during the winter into early spring.
And when you say hold together, from a technical perspective, what you're looking at is it isn't violating any more technical downtrending signals.
Right. It's just staying, you know, if we look at the weekly charts, it's just staying in a channel here. And, you know, if we look at the December Chicago, December Kansas City, they're just channeling near, yeah, they're down near the lows. I mean, they had this spike and they've come almost all the way back. But you know, we've got some commercial buying coming into Chicago. That tells us one of two things. One, demand's either better than what we expected, or we've got, maybe we don't have as many supplies as what we've thought all the way around. So whatever the case might be, market's not bullish, but it's not as bearish as it's been in the past, and it looks like it may have a little bit of hope somewhere down the road. I don't know exactly when, but it could break out of this channel.
All right, and Darin, you said you've got a little more reason to be optimistic, the wheat market. So that was optimistic, Darin. Now we're going to talk corn.
Okay.
How are we sitting there from a technical perspective? Again, we're just ricocheting around that 350 mark, but it seems like we're ricocheting, but now we're at 344. Where do we go from here?
Optimism and sunshine's gone.
Okay. Okay.
You know, we saw the December contract go to a new low. Actually, before the reports were released last week, a couple weeks ago, we saw a DC go to 342.5. And this really, you know, it mirrors what we see on the long-term chart as well, where we had the October 2014 low that held for a while, then the August 2016 moved below that. So we've got these patterns both on the long-term and the short-term charts that really just don't look good. Those, I mean, when you start going to new lows, that usually means sellers aren't afraid of this market. I mean, they're already net short in the corn market, non-commercial traders are. They're not afraid of this market because we have incredibly bearish fundamentals, and I don't care what USDA says. I'm looking at the spreads, and those are quite bearish.
And how are you interpreting those spreads?
I see the strong carry, say, between the DC March, May, and even out to May, July. So, you know, we're out 70% full commercial carry, calculated full commercial carry, all the way out through the July contract, and that's not a bullish situation. That means it doesn't matter what production is. It doesn't really matter what stocks are supposedly going to be. The market has plenty. The commercial side of the market views it as, you know, we've got plenty of grain that we're going to have. We don't have to worry about pushing the nearby contracts at all at this point.
Okay.
So that, to me, keeps the door open for the market to even go to new lows probably sooner rather than later.
New lows surpassing the 318 and 308 we saw in 16 and 17?
Probably not until next summer for that. I would anticipate the December contract going to a new low below the 342.5 mark. And then as we get into, say, winter and spring, get a little bit of a spike rally again. By the time we get to summer and early next fall, that's when we set a new low, long-term low below that 314.
So if producers are looking to store this grain that they're producing, this would be a time to make those sales, capture that carry.
Well,
is that how you're reading this market?
Yeah, you know, you hate to do it down here because we are near our lows. But if you haven't made any sales, you know, you don't want to just go out into the December because, again, you've got that carry all the way out to July. I would look out at least to July. You know, and capture as much as the carry as possible. The September contract's a bit squirrely, so I would certainly look out to the July.
All right. Well, now next I want to talk to you about the soybean market. And we've got a question here from one of our followers on Twitter, and we encourage all of you to send in Twitter comments questions for our analysts. This one's from Richard Jameson 9. He's asking, what do the technical indicators show for soybeans through the year's end and into early winter?
You know, it's an interesting question because, you know, soybeans are actually in kind of a fascinating pattern right now. Long term, it looks like they want to go up. You know, we've got this nice channel, we've got this trend line support that would indicate the market's going to go up. But on the other hand, it's got this same sort of trend line angling down that it can't get through. And it goes up and it pushes against it, you know, around 10, 20, whatever it might be, and it falls back down. And so what we've got is we've got a narrowing wedge in here. And, you know, usually the longer term momentum is going to win out. You're going to push through and you're going to break out to the side that the trend was going to begin with. And so that would indicate we've got an upward move possible here, probably in the spring and summer. But I'm a little concerned again by the spreads. They're getting more bearish. The Nov-Jan spread's getting more bearish. Jan-March is as well. And so that's got me a little bit concerned that if the non-commercial money who's already long this market decides to give up because spreads just aren't there, we've got some room to go down. We could break this thing down. And if corn actually is getting ready to go to a new low, it's going to be hard to rally soybeans. Technically, I still like soybeans. I like soybeans. You know, if I wanted to say I'm bullish or bearish soybeans, I'd still say I'm bullish beans. particularly long term, but I do see where the risk is that this thing
in
can
the
break down.
medium term, you're bullish long term.
Yep.
In the medium term through, let's say, end of first quarter 2018, you're watching that 10-10. Is that kind of what you see as maybe a potential upside?
Yeah, you know, if I've got some hedges on, I'm probably trying to roll them out to the Jan contract, and then when we get into the December time frame, I'm probably looking at just selling the cash. And if I'm open on cash, I don't want to be open on cash corn. You know, if I'm going into harvest and I don't have it all, I'd probably just look at, you know, taking my shots and selling it.
Okay.
But in the beans, I'm still thinking of holding some soybeans in here. I still like the long-term picture. That could certainly change. But to me, long-term, soybeans still look like they have the best upside potential, or at least more upside potential than flat-out holding cash corn.
All right. Now let's take a look at the livestock markets, Darin Newsom. We saw some cash trade this week, 110 thereabouts in the live cattle market. We saw the futures take a little step back, look like we're consolidating again, but still in the past 60 days, we've put $10 on this market. Where do we go from here?
Yeah, the live cattle market, you know, we spiked down early in the week, and then we did, you know, I think you mentioned we were like 55 points lower or something like that on the D's contract. That, you know, is still a loss, but it was well off the lows that we've seen. But the problem that I've got is similar to what we see in the grains, is that there's still a great deal of commercial selling occurring in the December contract, you know, with the spread and with the strengthening carry and the DSFEB spread. So that's got me concerned that, you know, I still think that these cattle are in a secondary downtrend.
Okay.
We sold off. We've got this pop back that you mentioned. Now I think we're going to fall back down.
Watching 110, how far can we drop this thing before contract expires?
That's the problem. We'll probably have to roll out these ideas to the Feb.
Okay.
Because by the end of November, no one's really going to be interested in the D's contract anymore. So we got the same pattern going on in the Feb. And what I would look for would be taking out that previous low in the Feb contract. Don't really remember exactly where that is, but the general idea is you come down, settle low, you bounce back up about 50% of what you came off, and then you go back down below that initial low. And so I would be targeting below that first low that we saw here, 4 to 6 weeks ago in the Feb contract.
Okay. Now, on the feeder cattle side, again, more pullback this week, same factors in play. Corn does continue to get cheaper. When you're watching from a technical perspective, is there a ratio you use, price of corn to price of feeders, or are you just watching that market by itself?
You know, basically the approach I take is you just take the titles off and you just look to see what each individual market shows.
Okay.
You know, if I was one of the smart analysts, I could figure out the ratios and I could do all that, but I'm not in that category.
Okay.
So I just
we appreciate honesty on market to market.
You know,
so what's the chart tell you here on feeder
the
cattle?
chart market, it is similar to the live cattle. They like to follow the live cattle for the most part, just to an extreme degree. You know, we'll see really, you know, make much larger moves than what we see in the live. So while I think there is some downside risk here to the feeder cattle market, you know, you can't help but point out that there is going to be some support come from corn if it does fall. So I think selling could be limited in the feeders. I think we'll see more pressure in the live for right now. Feeders probably come down, but just not to the same degree.
Okay. Now the next market, Darin, if we're going to find sunshine, it's got to be in the hog market. This has been a pretty incredible rally we've been on as we head into the largest pork production quarter we have been expecting since the last, 30 years or something. We continue to find strength. Is there optimism there?
Yeah. Actually, there is, and it's hard for me to say anything looks good, but I mean, I like the way the DSFEB spread worked this past week. We saw some commercial buying coming in, and this kind of backs up what we've seen going back 3 or 4 weeks, where we did see a bullish turn on the weekly chart for this was again the December contract. Feb had the same sort of pattern. So, you know, you get some non-commercial money coming in, some short covering occurring. You get the fundamentals starting to turn a little bit more bullish or less bearish, as the case may be. And it kind of feeds on itself. So if there is a market in the livestock sector that looks like it could continue to rally, I would say it does look like hogs.
Looking at a monthly chart perspective, how much more can we run? We're at 64, almost 65 today. Can we hit 70?
That's going to be tough. You
Okay.
know, I don't put a lot of stock in round numbers because computers really, don't see the difference between a 70 or a 68.5 or anything like that.
Okay.
That's just a real stretch, though. When you get up into that 69, 70, considering where we've come from, the market's going to start getting a little overbought at that, and you're just not going to find buyers as anxious up there unless we really see, say, not just the DFEB, but even going out to the Feb-April spread really start to show some strong commercial support. That's what the funds really need to see. They need to see these markets where there is, funds need to see a fundamental reason to buy. And right now, there just aren't very many markets showing that.
All right. Darin Newsom, thank you so much for taking the time to join us. We always appreciate your insight.
Well, thank you, Mike.
That wraps up the broadcast portion of Market to Market. However, we will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. And harvest is in full force for many, and some of the great images we found have been posted on our Instagram page of IPTV Market. Join us again next week when we'll see how farmers in the upper Midwest are dealing with an approaching deadline on buffer strips. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.